Welcome to TalkTickers. Today, we're diving straight into the recent Ford Motor Company earnings call.
Yeah, lots to unpack there.
We want to pull out the key insights you need to know. Basically, your shortcut to understanding what's really going on under the hood at Ford.
And it was quite the quarter. They actually significantly outperformed their own expectations in Q1.
How so?
Well, they reported an EBIT, that's earnings before interest and taxes, a key profitability measure of $1 billion.
$1 billion, wow. I thought they were guiding closer to break even.
Exactly, way above that anticipated near break even. And this positive surprise, it seems largely driven by continued progress on cost cutting.
Okay, cost cuts. And what else?
And strong net pricing, particularly in North America. That really helped.
But the top line, the revenue, that told a bit of a different story, didn't it?
It did, yeah. Revenue for the quarter came in at $41 billion.
Okay.
Which is actually a 5% decrease compared to last year.
Down 5%.
Yeah.
Why the drop?
Well, it was mostly due to planned pauses in production.
Yeah.
Downtime at several plants for rolling out new models and also rebalancing inventory.
The changeovers. Makes sense.
Right. And we also saw wholesales, the number of vehicles they sold to dealers, down 7% in the quarter.
Okay. And cash flow. How did that look?
Free cash flow showed a burn of $1.5 billion.
A use of $1.5 billion. What drove that?
They put it down to unfavorable timing differences on payments, some net spending, and changes in working capital.
Okay, so like you said, lots to unpack, a bit of a mixed bag on the surface, but financially, are they still on solid ground?
Oh, yeah, absolutely. Their balance sheet looks strong. They've got over $27 billion in cash reserves.
That's a healthy cushion.
And over $45 billion in total liquidity available. So plenty of flexibility there. They also declared their regular second quarter dividend.
The usual.
Yep, 15 cents per share, payable on June 2nd.
Okay. Now, the really big news, it seems, was about their outlook, their guidance for the rest of the year.
Yes, that was the headline grabber. Citing pretty significant near-term risks, mainly around tariffs and policy uncertainty, Ford has suspended their full year 2025 EBIT guidance.
Suspended it completely. What were they projecting before?
Well, to give you some context, their previous forecast, and this was excluding any potential tariff impacts, was between $7 billion and $8.5 billion for the full year EBIT.
Okay, so a decent range.
Right. Now, they estimate the net negative impact just from tariffs for the full year could be around $1.5 billion.
$1.5 billion net hit from tariffs alone. Let's dig into that a bit deeper. What's the total hit they're bracing for before they try to offset anything?
The initial estimate, the gross adverse impact on full year EBIT, is pegged at $2.5 billion.
$2.5 billion, okay.
So that net figure of $1.5 billion comes after they factor in about $1 billion worth of actions they plan to take to try and recover some of that cost.
Got it. And where are these tariff costs hitting them the hardest? Is it parts or finished vehicles?
It's roughly split, actually. About half of that $2.5 billion gross impact is attributed to parts imported for production.
Okay.
And the other half is from tariffs on finished vehicles they import.
Interesting split.
Yeah, and that calculation, interestingly, already assumes some credit they get for U.S.-made content in vehicles going over the border. It also wraps in impacts from steel and aluminum pricing.
Even though they source most of that domestically.
Right. Even though a majority of their steel and all their sheet aluminum are U.S. sourced, tariffs on some parts they import into China are also factored into that big number.
Wow, complex. So a $2.5 billion headwind, but they're aiming to claw back about $1 billion. How? What's the main strategy?
Their biggest lever, they're calling it market equation optimization.
Market equation optimization. Sounds fancy. What does it mean?
Yeah. It essentially means they'll be adjusting their pricing and volume strategies, tweaking things segment by segment.
Based
on competitive dynamics, what rivals are doing and where Ford feels it has an advantage.
Like pickup trucks.
Exactly. They specifically mentioned leveraging their strength in segments where they have 100% U.S. production, like full-size pickups. Play to your strengths, right? That's where they expect the bulk of that $1 billion offset to come from.
Makes sense. What else are they doing to lessen the sting of these tariffs? Any logistical moves?
Yes. They're looking at things like shipping vehicles made in Mexico that are destined for Canada through the U.S., but using bonded carriers.
Bonded carriers. So they don't technically enter the U.S. for tariff purposes.
Precisely. It's a way to move goods across the territory without incurring the import duties if the final stop is elsewhere. They're exploring similar things for parts that might just pass through the U.S.
Clever. Any changes to where they make things?
Well, they're also actively assessing near-term resourcing actions, basically, finding ways to increase the U.S. content in their vehicles quicker.
And what about their global footprint, especially regarding China?
They confirmed they've stopped exporting vehicles to China. But China does remain an export hub for them.
Exporting from China to other places.
Exactly, to other regions where trade relations are more favorable. And, while they say nearly 80% of the parts they use in the U.S. are already USMCA compliant.
U.S.-Mexico-Canada agreement.
Right. They're still continuously looking for opportunities to develop more local supply chains where it makes economic sense. They frame this not as a reaction, but as just continuing their existing strategy.
And they pointed to investments.
Yeah, they highlighted the $50 billion they've invested in U.S. manufacturing capacity just since 2020 as evidence of that long-term commitment.
Okay, shifting gears a bit. Away from tariffs, it sounds like they're also making good progress internally, specifically on costs and quality.
Absolutely. That $1 billion EBIT beat wasn't just pricing. They're on track, they say, to deliver $1 billion in net cost reductions this year.
$1 billion in savings. That's separate from the tariff offsets.
Correct. That's excluding the tariff impact. They're focused on closing what they see as a competitive cost gap and really leveraging that big U.S. footprint we just talked about.
How are they achieving these savings? What's changing operationally?
It sounds like a real focus on the fundamentals. Things like really thorough workstation readiness assessments before they launch new vehicles, trying to iron out kinks early.
Getting it right the first time.
Yeah. Plus a continuous pipeline of improvement ideas from the plants, rigorous in-plant audits, and using a system of leading metrics to catch potential quality or cost issues sooner.
And is it working? Are we seeing results in terms of quality?
It seems so. They're projecting year-over-year savings on warranty costs. They also said warranty spikes during new vehicle launches are now down to industry-leading levels. That's a big improvement.
That's significant. Fewer problems for customers.
Right. And for 2025 models, they expect a better than 10% improvement in repairs per 1,000 vehicles, both right at the start and 3 months in service.
Any external validation of this quality push?
Well, they were quick to point out that Ford and Lincoln were the most improved brands in the latest J.D. Power U.S. Vehicle Dependability Study.
Okay, that's a good sign. And the launches themselves. Smooth sailing.
They reported 0 vehicles lost during first quarter launches compared to their acceleration curves. So, yeah, smoother execution seems to be happening.
And software. They're doing more over-the-air updates.
A lot more. 9.5 million over-the-air software updates were deployed just in Q1. A big part of that is addressing customer concerns proactively.
9.5 million. Okay, let's move on to how the different parts of the business performed. Ford has those distinct segments now. Ford Pro, the commercial side.
Right. Ford Pro delivered a solid quarter. This was despite some of that planned downtime we mentioned and also some normalization of pricing in the commercial vehicle industry. Things cooling off a bit there.
But demand is still strong for certain vehicles.
Oh, yeah. Super Duty chassis cabs, transit wagons demand remains really robust for those.
And how's Pro doing overseas, like in Europe?
Still growing its commercial brand leadership there. And here in the U.S., they hold over 40% share of the Class 1 to 7 truck and van market. It's a dominant position.
That's huge. Any other highlights from Pro?
Growth in customer-paid mobile repair orders was significant. The van comes to you.
Convenience factor.
Exactly. And the software side is really taking off. Paid software subscriptions jumped 20% year over year to 675,000.
And are those subscriptions becoming more valuable?
Yes, that's the key. Strong growth in higher value services like fleet telematics drove a 40% increase in ARPU average revenue per unit or per subscriber.
40% ARPU growth is impressive. Okay, next up, Ford Model E, the EV division. Lots of focus there.
Yeah, Model E is really focused on 2 things right now: improving gross margin and being very disciplined with capital spending. This is happening as their battery investments scale up and they prepare for next-gen products.
How are the sales numbers for Model E in Q1?
Wholesale volumes more than doubled.
Doubled? Why the big jump?
Mostly driven by the European launches of the new Explorer EV, the Capri, and the Puma Jenny.
New products hitting the market. And in the U.S.?
U.S. retail EV sales grew 15%. They attributed some of that to their Ford Power Promise campaign.
A charger one?
Yeah, offering a home charger and standard installation. They said it has a 34% attach rate, which is pretty good. And they're expanding that offer to Canada and Europe now, too.
And the bottom line for Model E, still losing money, but improving.
Improving significantly. They showed a 40% improvement, both quarter over quarter and year over year. Lower material costs definitely helped there.
40% improvement, but they still expect it to be the best quarter of the year for Model E.
Yes, they tempered expectations slightly by saying Q1 would likely be the high water mark for Model E's performance this year.
Okay. Moving to Ford Blue. The traditional internal combustion engine side, how did they fare?
Ford Blue managed to earn a modest profit. This was despite the expected volume decline from those plant changeovers and also some negative impact from foreign exchange rates.
What helped offset those pressures?
Higher net pricing, again, primarily in North America,
Yeah.
and their international operations, excluding North America, were collectively profitable too.
Any particular models doing well in the Blue segment?
F-Series and Bronco continue to lead their respective segments. Bronco sales, in fact, were up a huge 35%.
Bronco still got legs.
Definitely. They also highlighted hybrids. The hybrid sales mix increased 2.5 percentage points globally. Customers seem increasingly interested there.
And newer models.
The newly launched Expedition and Navigator SUVs are doing well. Significantly higher average transaction prices, they said, and faster turn rates at dealers.
Good momentum there. Lastly, Ford Credit, the financing arm.
Ford Credit delivered strong EBIT earnings before tax.
Why was that?
Driven by a few things: a high-quality loan book, higher financing margins, and just more loans outstanding, higher net receivables.
So making good money on loans.
Yep, and they paid a $200 million distribution back to the main automotive company.
Always helpful. What about used car prices? That affects Ford Credit too, right?
Right. First quarter auction values were actually up year over year and sequentially.
Because used cars are still scarce.
Exactly. Low used car availability is propping up those prices, and their commercial lines of credit supporting Ford Pro customers also continue to grow.
Okay, so pulling it all together, a really complex picture. But the big cloud hanging over everything is this tariff uncertainty, leading them to pull guidance.
That's absolutely the key takeaway. The suspension really reflects these significant near-term risks they're trying to navigate.
What are the main risks they called out?
Potential industry-wide supply chain disruptions, the possibility of future or even increased U.S. tariffs, confusion over how tariffs might be implemented, the risk of retaliatory tariffs from other countries,
A lot of unknowns.
and just broader policy uncertainties, things related to tax rules, emissions regulations. It's a very fluid environment.
When will we get an update?
They said they plan to provide an update on guidance during the Q2 earnings call, so we'll have to wait a bit.
But despite pulling guidance, they seem to be leaning into their U.S. manufacturing presence as a strength, right?
Very much so. They repeatedly emphasized their U.S. footprint as a significant competitive advantage in this tariff environment.
Makes sense if imports are getting hit harder.
Exactly. And they also stressed their strong liquidity position again, saying it gives them flexibility for investments and shareholder returns, even with these headwinds.
Okay. What about the overall market? How are they seeing demand and managing their own inventory?
Well, the first half of the year, the U.S. market was actually quite strong. The SAAR seasonally adjusted annual rate was running over 17.5 million units.
Pretty hot.
Yeah, but they expect things to cool off in the second half. They're projecting industry pricing will increase by maybe 1% to 1.5% due to tariffs.
Leading to flat pricing for the full year.
Right. And they think this price increase will probably dampen demand, leading to a second half industry SAAR closer to 15.5 million units.
That's about 500,000 units lower than they originally planned for the year.
Approximately, yes. Whether that happens through higher sticker prices or just lower incentives, the timing might vary, but that's their expectation.
And Ford's own inventory, are they sitting on too much?
They say they're comfortable. End of April, dealer stock was about a 56-day supply. Gross supply was 66 days. They view it as giving them flexibility to be opportunistic.
And they're managing it carefully.
Vehicle line by vehicle line, they said. Constantly balancing tariffs, stock levels, the macro economy, and what competitors are doing with pricing.
Okay, let's talk tech for a moment. Software-defined vehicles, is that strategy changing?
The core strategy isn't changing, they insisted. But they did make a significant adjustment to their underlying electrical architecture for future EVs.
How so?
They had two forward zone architectures planned, FNV4 and another one. They've now merged those into a single one called FMV3.
Why the consolidation?
Primarily for capital efficiency, saving money. But they also say it will allow for more efficient software delivery down the line.
What are the benefits they expect from this FMV3 platform?
Well, it's going to be the foundation for what they call the CEO of Skunkworks product. Sounds like a future flagship EV.
Intriguing.
And they expect it to bring significant cost savings for future EVs, making them more affordable. Plus, enhance their ability to generate revenue from integrated software and services.
Their earnings call also touched on the supply chain risks again, beyond just tariffs.
Yes, that volatility in tariff policy itself could cause disruptions. They specifically mentioned importing rare earth materials from China becoming more complicated.
Critical stuff for EVs and electronics.
Absolutely. And just general uncertainty around supply availability tied into potential changes in tax and emission policies also poses risks.
Okay. What about automation? Any talk of like humanoid robots building cars?
Not quite yet. They said Ford isn't directly working on humanoid robotics itself.
But they are using AI.
Yes, partnering on specific AI projects in manufacturing aimed at cost savings. And they're deploying AI in product development PD to automate some design processes, cut down development time.
Any cool examples?
They mentioned using one of those Boston Dynamics dog robot Spot in their Valencia plant in Spain.
What's it doing?
Preventive maintenance. Using sensors to detect potential issues on the line earlier than humans might. So, AI is being used across quality, manufacturing, PD, really looking for efficiencies.
So looking ahead, what are the key things they need to see happen before they feel comfortable giving guidance again? What are they watching?
Number one is clarity on tariff policies. That's huge.
Makes sense.
Then, resolution of the uncertainties around tax and emission policies. They also need to see how customers react to potential price increases across the industry.
And how competitors react.
And competitive dynamics, exactly. How the whole landscape shifts.
How do government regulations, especially around emissions, fit into their thinking?
They see things like production tax credits, the IRA Inflation Reduction Act as critical enablers.
So supportive policies are key.
Very important. They're also watching the ongoing tax legislation discussions in the U.S. But it's a balancing act.
House.
Well, while the IRA offers consumer tax credits for buying EVs, which is good, they also anticipate needing to meet stricter CO2 requirements from the EPA, especially beyond 2027, plus California's rules. Those could act as offsets.
So push and pull?
Exactly. And global emissions policies matter too, of course. They did say their engagement with lawmakers and the administration feels positive, like there's a desire for Ford to succeed through this transition.
And they see this whole situation, maybe counterintuitively, as a market share opportunity.
They really do. They believe their big U.S. manufacturing footprint gives them a significant chance to gain share, precisely because competitors might have more exposure to tariffs on imports.
Playing that domestic card again.
Right. Plus, they have a fresh lineup in North America. New F-150, Super Duty, the big SUVs, many of which compete directly against imported models. Inventory's in good shape, they said.
Any signs they're already being aggressive?
They mentioned a recent employee pricing promotion that helped clear some dealer stock and led to share gains in March and April. They explicitly said they plan to be aggressive in the market.
Okay. That projection of a lower SAR in the second half due to price increases.
Yep.
How confident are they in that price sensitivity?
Well, that expectation of a 1% to 1.5% industry price hike, potentially lowering the SAR to 15.5 million, that factors in a bit of a payback from the strong first half run rate.
So normalizing a bit.
Yeah. And it's based on segment by segment modeling, looking at the typical price elasticity within each vehicle category. This is just for light vehicles, by the way, not medium and heavy trucks.
Are customers stretching to afford cars?
They are seeing customers adjust. An increase in people opting for longer-term financing to keep payments manageable.
Let's circle back to Ford Pro for a second. That subscription growth sounds key.
It really is. Strong growth continues in software and services, and they expect it to become a bigger slice of their overall EBIT pie by year-end.
Is it just software, or are physical services growing too?
Both. Investment in physical services is also driving growth. They're expanding the dealer network capable of servicing commercial customers, growing the mobile service fleet, now 4,600 units.
Wow, 4,600 mobile vans.
Yeah. And 66 operating Ford Pro Elite centers now. They're seeing higher service and parts attachment rates when customers use their Ford Pro intelligent software tools, too. It all connects.
Who's buying these subscriptions? Big fleets, small businesses.
It's across the board, apparently. Small, medium, and larger fleets. But telematics subscriptions were a standout, up 80%. That was the key driver of that 40% ARPU growth we mentioned.
Is Pro facing any headwinds?
Some pricing pressure noted from import competitors, specifically in heavy-duty vans and pickups. Also some pressure in the rental market, although they say their rental volume is smaller and more profitable now.
Okay. What about Ford credit and tariffs? How do those intersect?
Well, as we said, elevated auction prices for used cars are already happening due to low supply.
Right.
The thinking is higher new vehicle prices from tariffs should, in theory, help support those used auction values in the near term, keep them high.
What?
But that could be muted if the economy slows down in the second half, as they sort of hinted might happen. A lot of demand overall could soften prices eventually.
What else are they seeing at Ford Credit?
That increase in applications for longer-term financing, a lower SAR overall would naturally mean fewer contracts written, fewer loans originated. So, yeah, the picture for Ford Credit is kind of balanced, really depends on the economy later this year.
How's the business over in Europe looking these days?
Some positive signs there. Recent EV launches, like the electric Puma, are apparently off to a good start.
And the commercial side in Europe?
Still very strong. Their commercial vehicle share actually increased by over 2.5 points in Q1 over there.
It's a solid gain.
Yeah. And having flexibility across powertrains, ICE, hybrid, plug-in hybrid, full electric, that allows them to respond better to whatever the market wants in different countries. Overall, the European business rate is improving, they said, despite some headwinds. Share gains helped offset those.
Looking back at Q1, what was the biggest positive surprise for them internally?
Cost performance. That was the main one they highlighted. Particularly, warranty costs came in better than planned and improved from Q4. Material costs, including commodities, also performed better than expected.
And that helped offset.
Helped offset the $200 million negative impact they felt from tariffs just within Q1.
Okay. And Model E's turnaround in Q1, what really drove that 40% improvement? You mentioned material costs.
Yeah, material cost improvements came through earlier than they anticipated. Also some positive pricing effects, partly carrying over from actions taken last year. But again, they cautioned it's still expected to be the best quarter of the year for Model E financially.
What about Mach-E production? Any plans to cut back given the focus on cost discipline? It's made in Mexico, right?
Right, made in Mexico, no planned reductions, they said. Mach-E actually has a low day supply, inventory is tight, and it's essential for meeting compliance regulations.
So still important.
Very. They've actually shifted some production allocation towards Europe because demand is higher there currently. But Mach-E sales remain strong, they emphasized, even in its fourth year, which is different from how ICE vehicle life cycles typically work.
What's the cash impact of these tariffs? Is it the same as the EBIT impact?
Roughly, yes. The current estimate is that the cash impact will be approximately equal to the $1.5 billion net EBIT impact. That assumes the payments and the offsets happen mostly within the same time frame.
Any other cash hits from tariffs?
There will be some CapEx impact too. Tariffs hitting some equipment they'd already ordered from overseas for their plants.
Okay, last couple of things. If the whole industry raises prices more than that 1 to 1.5% they expect, will Ford follow suit, or will they prioritize grabbing that market share they talked about?
Sounds like a game time decision. They said they'll evaluate market conditions, vehicle by vehicle, segment by segment, look at profitability. They want the flexibility to either participate in price increases or push for share, depending on what makes the most sense for each product line.
Makes sense. And finally, any update on self-driving tech? Level 3 autonomy.
Their current system, Blue Cruise versions 1.4 and 1.5, is performing well. Hands-free miles driven are up 15%, now over 370 million miles total logged by customers.
That's a lot of miles.
It is. Level 3 development, the next step up, is apparently on track. They're also evaluating level 4.
What's the goal with level 3? Be first.
Not necessarily first, but best. They want their level 3 system to be a differentiated product, sourced internally, unlike Blue Cruise, which relies more on suppliers. The goal is to be, quote, the best for high-speed highway autonomy when they do launch it.
Okay, that pretty much covers our deep dive into Ford's recent earnings call. The uncertainty, particularly around tariffs, is clearly the major challenge right now.
No doubt about it. But you also see these underlying signs of progress in cost management, quality, and they're really leaning on that U.S. manufacturing base as a potential advantage. It's a compelling story to follow.
Absolutely. How effectively Ford can navigate these tariff headwinds while maybe even capitalizing on their domestic production strength. That's going to be key in the coming quarters. Will the offsets work, or will tariffs really reshape the competitive field?
We'll definitely be keeping a close eye on their Q2 earnings call for updates on that guidance and how things are trending.
Right. And now let's put on our purely speculative hats for our This Is Not Financial Advices segment.
Okay, disclaimer up front. Purely hypothetical, just a thought experiment based on today's discussion.
Go for it.
So given Ford's heavy emphasis on their U.S. manufacturing advantage and the potential for import-heavy competitors, especially maybe some European ones, to face more tariff pressure, Here's an idea.
Okay.
Consider hypothetically a pair trade, a long position in Ford stock, paired with a short position in maybe a broad index tracking European automotive manufacturers.
Interesting. The thesis being,
that Ford's domestic focus might shield it, relatively speaking, from some global trade friction compared to European automakers who rely more heavily on exports and complex global supply chains, potentially hit harder by tariffs.
playing the relative strength card.
Exactly. But huge caveats. The risks are massive. Trade policy could shift unexpectedly in any direction. A broad economic downturn could hit the entire auto sector, regardless of tariffs. Currency fluctuations are another risk.
So absolutely not investment advice.
Not even close. Just connecting some dots from the call into a speculative structure. Always do your own deep research and understand the risks before considering any trade.
Always do your own due diligence. Thanks for tuning in to TalkTickers. Let us know what you think about Ford's quarter and outlook. We'll catch you next time for another deep dive.